Hello everyone, welcome to our live earnings season special. I'm here in the city in London and we're going to talk about earnings which are crossing as we speak. We are dealing with the bank earnings from JP Morgan and Wells Fargo at the moment. We've had those crossing on the wires, so we've got JP Morgan net income at 9.7 billion, return on equity at 15%, so looking quite healthy there. Q3 EPS came in at $3.12. That's up from the $2.90 roughly expected. So JP Morgan doing a little bit better than expected. I think a lot of people have been negative about the banks going into this, saying that although net interest income is rising, there's too much pressure on the macro with inflation and with consumers dialing back, and also investment banking revenues maybe not holding up as well this time versus last year, which was of course a bumper year for trading revenues and for investment banking deals. So we had a $1.5 billion net loan loss provision. We had $1.7 billion in investment banking revenues versus $1.6 billion expected, so doing a little bit better there versus expectations, and the company saying it expects to resume buybacks sometime next year. Looking ahead, expects full year 2022 firm-wide adjusted expenses of about $77 billion. Expense has been a problem for the banks over the last few quarters as wage demands have gone up significantly. Expect Q4 net interest income excluding markets of about $19 billion for a full year about $61 billion for the full year. That is market dependent though. So JP Morgan shares were rising a little bit in the pre-market ahead of this, ahead of the announcement or ahead of the market open, and you can see the stock behind me has had a rough year. The banking index is down by about a third this year, and JP Morgan has been caught up in that sell-off. Now on to Wells Fargo. We've got Wells Fargo coming in at $3.5 billion in income. Earnings per share 85 cents, and that included a 45-cent loss, or $2 billion relating to previous litigation, regulatory problems and so on. So they've booked that loss, and it would have been $1.30 had it not been for that loss. It's also added $784 million put aside for credit losses. That's versus about $1.5 billion that it got as a bonus, as a deposit on the plus side last year, as it unwound some of the big provisions that many of the banks have put aside during COVID that they didn't need because of all the central bank and fiscal support. Net interest income came in at $12 billion. So bank earnings so far probably not as bad as feared, and that might be another cue for the market to rally out. We saw yesterday a big bounce off very oversold levels for the market. The S&P hitting 3,500, and that was a trigger for a huge amount of buying. Everyone's uber bearish. There's a lot of cash on the sidelines, and people looking to trade that bounce, and they got it. There was also perhaps a good amount of short covering there, but it's question mark is whether there's enough to go forward. The bank's talking about macro risks persisting, inflation being a problem. Still, consumers still strong though in the US, but they are having to put aside more for credit losses and delinquencies. Looking ahead, we have some more earnings coming up next week as earnings season gets into full tilt. Watch out for Netflix. It's just announced that new ad-supported platform, a cheaper version of the service. We'll wait to see what sort of benefits it might expect from that. Analysts have been pretty positive on that one, Evercore and Oppenheimer among them, though there are some doubts about whether people spin down. So people, during a recessionary environment, people trade down and they actually opt for the cheaper option, and that weakens Netflix's margins. And then we also have Tesla, which reported weaker than expected deliveries in the quarter, and we wait to see what sort of margin erosion we might get on that stock. Of course, that stock is a proxy for the Twitter deal as well, so keep your eyes on that one. We've also got earnings from Snap, which sank the digital advertising sector back in July when it reported weaker earnings. It's since been cutting costs drastically, and we wait to see whether or not there's any uplift there. And that has a read across for the likes of Google or Alphabet, as parent company is called, Facebook or Meta, and Twitter as well. Although Twitter, of course, is really hinging on the deal with Elon Musk. So that's it for now. Bank earnings kicking off earnings season. We've got some more coming up. Monday there's Bank of America, Goldman Sachs coming up next week as well. But so far, JP Morgan, Wells Fargo not delivering a killer blow to the market, and this could be a catalyst for further trading later today. Meanwhile, keep your eyes on the UK announcement coming at 2 p.m. British summertime from Liz Truss. Seems that she sacked the Chancellor, and there could be a U-turn on some of that budget tax cutting agenda. That's it for now. Thanks very much for joining us.